Welcome back, everyone, to another deep dive. And today we're going to be taking a look at this really fascinating report called The Coming Economic Calamity as an Outcome of Current U.S. Monetary Policies and Fiscal Deficits. And, we've been talking about getting into this for a while. So I'm excited to really unpack this thing and try to really figure out what the author is trying to tell us about, the state of the U.S. economy and where things might be headed.
Yeah, I think this report is really interesting. It's not just your typical, sort of dry economic analysis. It actually draws on a pretty diverse set of sources. It's got historical financial data, of course, and government statistics, but the author's clearly looking at those with a critical eye. And there's also a lot of commentary and perspectives from different economic experts and thinkers. And what I found really interesting was how the report actually starts off, right at the beginning. It's got these quotes from people like Eve Ensler and Noam Chomsky, and they're talking about truth and distortion and how difficult it can be to really understand complex information. So it kind of sets this tone right from the get-go, that we need to be questioning what we're being told and really digging deeper.
Yeah, that's a great point. And speaking of digging deeper, the author kind of has this unusual opening where they talk about Ritchie Blackmore, the guitarist from Deep Purple. And they say that their research into Blackmore's life and career actually got them thinking about this whole idea of public perception versus private reality.
Yeah.
So I'm curious, how does that connect to the economic arguments that the author's making?
Well, I think it's all about this idea that things aren't always what they seem, on the surface. And the author was looking into the origins of Deep Purple, and they came across this detail about Blackmore that really resonated with that theme. So for those who aren't familiar, Deep Purple is, one of the pioneers of hard rock and heavy metal. They formed in London back in 1968. And the original lineup was Nick Simper on bass, Ian Pace on drums, Rod Evans on vocals, Ritchie Blackmore, of course, on guitar, and John Lord on keyboards. And they were right up there with Led Zeppelin and Black Sabbath. They were even listed as the world's loudest band in the 1975 Guinness Book of World Records. So pretty impressive.
Wow, that's pretty loud.
Yeah, it was a different era.
So how does Blackmore fit into all of this?
Right. So Blackmore was this incredible guitarist, just like, a real virtuoso. And he went on to form Rainbow with Ronnie James Dio later on and had a very successful career. But the thing that the author picked up on was that Blackmore apparently really hated school. Intensely. He felt like he didn't fit in and the traditional education system just wasn't for him. And so he ended up leaving school when he was 15 to become an apprentice radio mechanic. And he also started taking guitar lessons. And so, he kind of found his own path outside of the system. And the author draws this parallel to the world of economics and finance. They suggest that people might enter these fields with, certain ideals and goals, but then they find themselves operating within these systems that are influenced by things like bailouts and fiscal deficits. And, maybe those systems end up pushing them in directions that they didn't initially intend to go. So it's kind of like this gap between intention and reality, whether it's in music or economics.
Yeah, that's a really interesting way to think about it. And it kind of leads us right into one of the core questions that the report is wrestling with, which is how reliable are our official economic statistics? The numbers that we're seeing actually reflecting what's happening in people's lives. And the author seems particularly concerned about this divergence between, the inflation that we're seeing in asset prices, things like stocks and real estate, and the inflation that's affecting the real economy, the cost of everyday goods and services. So it's almost like asking, are we measuring the right things? Are we looking at the right indicators?
Yeah. Exactly. And the report is arguing that the story that we're being told, about economic recovery and inflation, it might not be the whole story. It might not be capturing the full reality of what the average person in business are experiencing. And so it's urging us to look beyond those headline numbers and really dig into the details.
Okay, so let's do that. Let's start digging into some of the specifics. And the first area that the report focuses on is this idea of illusions of wealth and income. And it uses the S&P 500 as an example to illustrate this gap between nominal returns and inflation-adjusted returns, and the numbers are pretty striking.
Yeah, it's really eye-opening to see the difference that inflation makes over the long term. So the report lays out this scenario where you imagine investing $100 in the S&P 500 back in 1970, and by the end of 2024, that investment would have grown to around $27,369. So that's a pretty impressive 10.86% average annual return. But here's the catch. When you adjust for inflation, the inflation that occurred between 1970 and 2024, the real value of that investment in today's dollars is only about $3,280. So that brings the real average annual return down to 6.68%, which is still decent, but, it's a lot less than the 10.86% that we saw before. And so basically a big chunk of that gain that we saw initially, it was just keeping pace with rising prices.
Right. And so the report then kind of asks this question of, have stock market returns since 1970 been unusually good, historically speaking? And would using different ways to calculate inflation change that picture significantly? And it points out that there were periods, after big market events like 1929, 1966, and 1998, where inflation-adjusted returns on U.S. stocks were actually pretty bad. So it really makes you think about what we mean by growth. Are we just talking about nominal numbers that don't account for the fact that the value of money is constantly changing, or are we talking about real purchasing power?
Yeah, that's the key question. And the report is really pushing us to consider, what's the right yardstick to measure success? And are we maybe fooling ourselves a little bit by focusing too much on the raw numbers and not enough on what those numbers actually mean in terms of our ability to buy goods and services?
Right. And so this skepticism about inflation measurement then kind of leads the author into this broader critique of official government statistics, particularly when it comes to things like unemployment and inflation rates. And the report mentions Al Sindlinger, who was the chief economist at the Conference Board back in the late 70s and early 80s. And he was raising concerns about the way that the government was calculating unemployment using something called the birth-death model. And he was also noticing this disconnect between, what the GDP numbers were saying and how consumers were actually feeling. So it's like he was seeing this gap between the official data and the real lived experiences of people.
Yeah, Sindlinger was definitely ahead of his time in some ways. And, the birth-death model that he was critiquing it basically tries to adjust unemployment numbers to account for the fact that new businesses are constantly being created, births, and existing businesses are failing, deaths. But Sindlinger was concerned that this model might be overestimating the number of jobs being created and therefore understating the true unemployment rate. And he was also pointing out that, even when GDP growth looked okay, consumer confidence was often lagging, suggesting that people weren't actually feeling that economic growth in their lives.
Yeah, that's interesting. And then the report kind of takes this historical perspective and brings it into the present day, with John Williams of ShadowStats, who has a very critical view of the current situation. He basically argues that the policies that the U.S. government is pursuing are actually pushing us toward an inflationary recession or even a depression. And he points to the fact that consumer sentiment is much lower now than it was before the pandemic as evidence of this.
Yeah, Williams is definitely a contrarian voice in the economics world, and he doesn't pull any punches. He's basically saying that while the Commerce Department is reporting positive real GDP growth, if you look at the underlying monthly economic data and adjust for inflation in what he believes is a more accurate way, it paints a much bleaker picture. He sees economic activity as being flat or even declining. And a big part of his argument is that the government has changed the way it calculates the consumer price index, CPI, over time. And he believes that these changes have tended to understate the true level of inflation. So, he's basically saying that if you use a different measure of inflation, you get a very different picture of the economy's health.
Yeah, that makes sense. And then the report shifts gears a bit and brings in David Stockman from the Brownstone Institute. And he's looking at the impact of all this money that's been printed, the massive $6.5 trillion in quantitative easing. And he comes to some pretty interesting conclusions about the industrial production index and how it compares to historical growth rates.
Yeah, Stockman's analysis is really interesting. He's basically asking, has all this money printing actually led to an increase in real output? Are we actually producing more goods and services? And he uses the Industrial Production Index, which measures the output of factories, mines, and utilities as a proxy for real economic activity. And what he finds is that since August 2008, the Industrial Production Index has barely budged. It's only increased by an average of 0.15% per year, which is incredibly low. And if you compare that to the period between 1950 and 2008, the Industrial Production Index was growing at a much healthier rate of around 3.5% per year. So it's a huge difference. And even though official real GDP growth has averaged about 1.91% per year since 2008, Stockman argues that if you use what he considers more realistic inflation adjustments for things like goods, healthcare, and government spending, the real GDP growth rate drops to around 1.2% per year, which is pretty anemic.
Wow. So he's basically saying that all that money printing hasn't really translated into meaningful economic growth.
Yeah, that's exactly his point. And he goes on to argue that instead of boosting the real economy, all that money has mainly flowed into financial markets, inflating asset prices and creating bubbles. And he also talks about malinvestment, which basically means that resources are being directed into unproductive areas. And he argues that this whole situation has disproportionately benefited foreign producers. So it's a pretty scathing critique of how monetary policy has been conducted.
Yeah, it's pretty thought-provoking, and the report even mentions this economist, Fritz McClup, who was writing back in the 1930s, and apparently he was already grappling with these questions about how credit expansion and money supply can impact the economy in different ways. So it's not like this is a new debate.
Yeah, these are fundamental questions in economics, and they've been debated for centuries. And it's interesting to see how those debates are playing out in the current environment.
Right. So speaking of debates, the report then dives into this really important distinction between real interest rates and nominal interest rates. And it uses the 1970s as an example to show how you could have rising nominal interest rates, but if inflation is even higher, then you actually have negative real rates. So it's like the illusion of tight monetary policy, when in reality, things were actually quite loose.
Yeah, this is a really crucial point to understand because it can be counterintuitive.
Right.
You see interest rates going up and you think, okay, things are getting tighter, but you have to factor in inflation to get the real picture. So in the 1970s, nominal interest rates were climbing significantly. Like long-term treasury yields went from below 5% in the mid-1960s to over 7% by 1970, and then all the way up to over 15% by 1981. But when you adjust for the high inflation that was happening during that period, the real interest rates were actually negative for much of that time, until about 1980. And so you had this situation where even though interest rates were going up in nominal terms, they were actually negative in real terms. And that's when you tend to see things like higher inflation, a weakening dollar, and a surge in the price of precious metals.
Yeah, that makes sense. And so the author is basically arguing that even though interest rates are higher today than they were for much of the past decade, they're still negative in real terms. And they point to the fact that gold is at an all-time high as a potential market signal that investors are recognizing this reality.
That's their interpretation. And it's an interesting one. The argument is that if inflation is higher than the nominal interest rate, then lenders are losing purchasing power over time and borrowers are effectively being paid to borrow money. And so the fact that gold is rallying could be seen as a sign that the market is anticipating continued inflation and a weaker dollar in this environment of negative real rates.
Okay, so the report then broadens its scope a bit and starts looking at some broader economic concerns. And it references Peter St. Onge, who has found that there's actually been negative job creation in small businesses, which, employ a huge percentage of the U.S. workforce. And he's also found that growth in mid-sized businesses has been pretty stagnant. And there's even some evidence that larger businesses are starting to weaken due to recent layoffs. And Mike Mishedlock is even more pessimistic. He's basically saying that we might already be in a recession.
Yeah, these are definitely some troubling signs. And if small businesses, which are often seen as the engine of job growth, are actually shedding jobs, it suggests that the labor market might be weaker than the headline unemployment numbers suggest. And Shedlock's view is that the official data might be lagging behind the reality on the ground and that the economy is already contracting.
Right. And the author of the report also shares their personal view that, a lot of people are already feeling the effects of a recession because the cost of living is rising faster than their incomes. So even if they still have a job, their purchasing power is being eroded. And the report also highlights this pretty stark divergence between job openings in the private sector, which are plummeting, and job openings in the government sector, which are near record highs. So that raises some interesting questions about, the long-term sustainability of that trend.
Yeah, that's an important point because even if the overall unemployment rate looks okay, if the cost of essential goods and services is rising rapidly, then a lot of people are effectively experiencing a decline in their standard of living. And this divergence between the private and public sectors is also something to watch closely because it has implications for things like productivity, innovation, and the overall structure of the economy.
Yeah, for sure. And so let's talk about the specific inflationary pressures, because the report gets into some really granular detail about how different goods and services are being affected. And it cites the Kobesi letter, which found that while overall CPI inflation was around 2.9% in July, many everyday necessities were experiencing much higher rates of inflation. Things like car insurance, transportation, hospital services, rent, and even food away from home were all seeing much bigger price increases. And the report emphasizes that the U.S. dollar has actually lost 25% of its purchasing power since January 2020 due to this cumulative inflation. So that's a pretty big hit in a relatively short amount of time.
Yeah, those more granular inflation numbers really highlight the fact that the headline CPI can be misleading. It might show a relatively modest level of inflation, but if the prices of things that people need on a daily basis are rising much faster, then it's going to have a real impact on their budgets. And the fact that the dollar has lost a quarter of its value in just a few years is a testament to the corrosive power of inflation, even when it's not super high.
So this brings us to the author's concerns about asset markets. And, we're seeing equities near all-time highs, gold at an all-time high, Bitcoin near a high, the dollar weakening and house prices still elevated. And so the author is questioning whether cutting interest rates would actually be a good idea in this environment. And they use this kind of quirky example of Harrison Ford's fedora from Indiana Jones selling for a huge sum at auction to illustrate this broader point about asset inflation.
Yeah, it's an interesting example, and I think the author is trying to show that even though interest rates have risen recently, monetary policy might not be as tight as some people think. There's still a lot of liquidity sloshing around in the system, and that's pushing up asset prices across the board. So even things like collectibles are seeing big price increases. And so the author is basically saying, be careful about assuming that just because interest rates are going up, that means that asset prices are going to come down.
Right. And the report also looks at the housing market specifically.
Right.
And it cites Anthony B. Sanders, who argues that these proposed first-time homebuyer subsidies could actually backfire and end up pushing prices even higher because buying conditions are already so difficult. And the author connects the Fed's money printing to the fact that housing affordability in the U.S. is at an all-time low. So it's like the housing market is this case study in how monetary policy can create distortions.
Yeah, the housing market is really interesting because it's so sensitive to interest rates. And, we saw how low interest rates fueled this huge boom in housing demand and prices. But now that rates are rising, affordability is becoming a major issue. And Sanders' point is that if you try to artificially boost demand with subsidies, you might just end up pushing prices even higher and exacerbating the problem.
Okay, so given all of this analysis,
Yeah.
what are the key takeaways? What are the implications for investors and for the economy more broadly?
Well, I think the main takeaway is that the author is quite pessimistic about the outlook. They don't believe that simply printing money is a sustainable solution, and they see a lot of distortions in the economy that are being caused by these policies. And they also believe that rising bankruptcies are a sign that things are starting to unravel, and they're not convinced that cutting interest rates is going to fix the problem.
So what are they suggesting investors do?
Well, the author lays out their own investment strategy, which is heavily tilted towards precious metals like gold, silver, and platinum. And they also like certain mining companies that are involved in the production of those metals. And they see the rising price of gold as a signal that real interest rates are negative, that inflation is likely to persist, and that the dollar is likely to weaken.
Okay, so they're basically saying that in this environment, precious metals are a good place to be.
That's their view. And, they're not alone. There are a lot of investors who are concerned about inflation and the direction of the economy, and they're looking for assets that can hold their value in that kind of environment.
Right. And the report also mentions Tom McClellan, who's suggesting that crude oil prices and the Canadian dollar might be headed higher based on how commercial traders are positioned in those markets. And there's also Ed Yardeni, who has observed this inverse relationship between the Japanese yen and the NASDAQ Q100, which he sees as a potential warning sign that the current speculative environment might be vulnerable to a reversal. So it's like there are all these different signals flashing in different parts of the global financial system.
Yeah, and those signals seem to align with the broader themes that the report is exploring. This idea that there's a lot of complacency in the markets, that valuations are stretched, and that the fundamentals might not be as strong as people think.
Yeah, and speaking of valuations, the report also points out that the Japanese yen is actually quite undervalued relative to the U.S. dollar based on price differences between the two countries. And they suggest that the yen could strengthen, which would have implications for other Asian currencies. And they even mention the Singapore dollar as an example of a currency that's already appreciating against the dollar.
Yeah, that's an interesting observation. And it suggests that there might be some opportunities in the currency markets for investors who are willing to look beyond the U.S. dollar. And, the yen has been very weak for a long time. So it wouldn't be surprising to see it start to appreciate, especially if the U.S. dollar continues to weaken.
Okay, so lastly, the author expresses a positive view on emerging market bank stocks, particularly in Latin America and Asia. And they believe that those stocks could benefit from a weaker U.S. dollar. And they also highlight this chart from the bank credit analyst that compares the total market value of the U.S. Magnificent Seven tech giants to the total market value of thousands of Chinese stocks. And they call it a standout chart of 2024 because it really illustrates the potential relative value that might exist in overlooked parts of the market.
Yeah, that's a really interesting chart. And it kind of makes you wonder, has the U.S. tech sector become too dominant? Have those companies gotten too big? And is there maybe more opportunity in other parts of the world, like emerging markets where valuations are lower and growth prospects might be better?
Yeah. It's a good question. And then the report concludes with a couple of thought-provoking quotes. There's one from Leon Levy that warns about the dangers of self-delusion in falling asset markets. And then there's one from Javier Milei, who has his book called Common Sense Economics for Uncommonly Dumb Politicians. So it's like the author is leaving us with these kind of parting shots, urging us to be skeptical of the consensus view and to think critically about the economic and political choices that are being made.
Yeah, I think that's a great way to sum it up. This report is really a call to action. It's saying, hey, pay attention to what's happening, question the narratives that you're being told, and don't be afraid to think for yourself.
Well said. So to kind of bring it all full circle, this deep dive into this very provocative report has really revealed some key tensions. This potential disconnect between official economic data and the lived experiences of many people, the questionable effectiveness of current monetary policies in generating real economic growth versus their impact on asset prices, and these rising risks of an economic downturn, despite some seemingly positive surface-level indicators.
Exactly. And I think the report is really challenging us to look beyond the headlines and to consider the longer-term consequences of the policies that are being pursued.
Absolutely. So for you, our listener, the question that we'll leave you with is this: given all of this analysis, what do you anticipate as the potential long-term consequences for your own personal financial planning and for the broader societal landscape if these trends continue? And what overlooked indicators might provide a clearer and more timely understanding of the true economic situation? So thanks for joining us for this deep dive, and we'll see you next time.
Thanks for having me.